And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And welcome to Financial Fitness Friday. I'm Rich Rosso, certified financial planner, here with Danny Ratliff, certified financial planner, and we're so glad you're here. Hope everybody is driving safe. And it's, before you know it, the weekend. If there is such a thing.
What is that?
It's just merely the end of the week.
Perfect.
Or as Connie likes to say, the beginning of the work weekend. We got a lot of earnings that have come out so far, and obviously every quarter we play this little game where the bar is set low and the companies beat it. But I will tell you, some have been relatively impressive. And what's important, Danny, I think guidance has been good, which I was wondering how that would look. You know, as stimulus checks and we see retail sales hit records and GDP was in excess of 6%. You just wonder when the sugar high is going to be over. Boy, I've heard some crazy stories about what people are doing with their stimulus checks.
What's the craziest thing you've heard?
Someone spent it all on lottery tickets.
Well, that's the first one. I haven't heard that one yet.
Yeah, just because, the money was there.
Yeah.
And, I mean, like 2 out of every 5 stories I've heard have been people just blowing the money on stuff.
Okay.
Not like necessities. So that just shows you that when big government gets involved and they start throwing money out there and not really sort of try to find a way to see who needs it or not, it is what it is. So obviously a lot of that wound up in the economy. So the big question is going to be, well, heck, once this honeymoon's over, people want to get out and we go back into sort of a normal, whatever that is, routine. What does the economy look like? I would dare to say, Danny, the bond market is telling us something very different from the stock market in the perspective. And by the way, Michael wrote a really great article about the stock and bond market yesterday, a couple of days ago. It's a really good article about what the bond market and the stock market are saying about things. But I think the bond market is trying to tell us is that we're pretty much going to get through this honeymoon stage and then fall back into somewhat of a malaise with all the debt we've taken on. So with GDP, that would be back to where we were, 1.8, maybe 2%. There's no new, this is the beginning of something different, the new 80s, all of this talk. We are just really rebounding, not expanding. It's two different terms. Again, I still think we'll be healthier than the rest of the world. So relatively speaking, we're still going to be the cleanest dirty shirt. It is really more based on the fact that other countries look so badly. I mean, the EU had negative GDP. I've read some really disconcerting kind of stuff about China and their demographics. And demographics, that is the economy. That is the growth of the economy. And our demographics aren't very good. So again, there's some major structural cracks that take time to work through. So the bond market, I think, is trying to say is, hey, once the honeymoon's over and the euphoria built, what's left?
Yeah, and just recently, I think we've seen a major change and shift in the bond market because rates have been much higher. We have seen them creep back up from a 10-year perspective. But so yesterday I had a phone call, Rich, and he said, hey, I have a family member has a CD coming due. The bank wants to basically renew them at like 0.09.
0.09.
Okay, yeah. And so he said, hey, can you find anything? Can you go on at one of your custodians and find something better? And I said, yeah, let me go poke around. I'll see what I can find out there. Mm-hmm. So went first to Fidelity.
Okay.
And started looking at rates. I thought, whoa, this isn't good. They had a 1 year, the top rate they had was 0.10. 18-month, 0.15, 3-year, 0.30, 4-year, 0.50. So I started saying, okay, let's go look at the banks, like the online banks. They can pay a little bit better from time to time.
We always talk about that, right? Because relatively speaking, they should be doing better
Correct.
than your brick and mortar.
Correct.
Yeah.
So I went to Marcus, and they had 0.50 for their savings account.
That's not bad.
For their CD, it was 0.55.
Really?
But what this would indicate is that they're not buying it. So like we talked about smart money being the fixed income market.
Oh, you mean they're not letting go or selling these bonds, or we're not seeing rates move, to your point? Yeah.
Well, they've been much higher. I mean, even over the last several months, I mean, you've been able to go out and find something better than what we have right now.
Yes.
And so this would indicate to me, like you mentioned, maybe they're just not buying it.
I think, again, there's a bit of other things in the soup of bonds, purchases from overseas and so forth. But I do agree with you that I think the bond market is trying to say, guys, this actual explosive kind of growth we're seeing, sort of transitory. We will fall into more of a normal pace. And when we look at earnings of where these companies are as far as PEs, not that anybody cares about price to earnings anymore. I mean, you're pulling in from the future, maybe 5 years to a decade's worth of growth that these companies have to sort of fit into. It's like you I don't know if you ever remember this. Brent probably would. Do you remember going to get new shoes for a holiday?
Oh, yeah.
And mom, they would put your foot in that steel thing to get your size, but then mom would say something like, well, make it a little bigger because he'll grow into them.
Right. I think they still use those, Rich. You just probably haven't had to use one in like 40 years.
I haven't. I don't go to shoe stores anymore. But the point is, it's almost like these companies have these huge shoes, right? And their feet are earnings, and their feet have to grow into the shoes. And I don't know how long that's going to take for that to happen. How do you like that leap this morning?
Very good.
Being up since 2 a.m.
Stuck your foot in that one, didn't you?
Yeah, I sure did. Obviously. I'm going to get one of those steel things.
Yeah.
Put it on Danny's seat. So when he sits, he's got a real thrill. Those things hurt. Let me tell you, my grandmother almost hit me in the head with one of those things at the store. Those things were like weapons.
They could be. That's one thing that technology is something that really hasn't changed.
That's amazing. Who makes those? I mean, the company who makes those, that guy's got to be the richest guy in the world. He doesn't say a word.
His name was Tom McCann.
Oh, I could smell a McCann coin coming.
Yeah.
New token.
Are you being serious?
Of course not.
No, but you never know if that was the
Friday morning.
But you never know if Tom McCann was
well
part of the original.
Yeah.
Kind of thing.
You never know. Brent's an encyclopedia of information, so it's like, hey, okay.
He is like
the word for it.
He's like the Yoda of stuff we don't care about.
I remember Tom McCann shoes, though.
Oh, I was going to thought you said you remember Tom McCann. I mean, you were pretty young at the time.
Well, we were soul brothers.
Well, yeah. Remember Buster Brown with the little dog?
Yes.
Yeah.
Yes.
I have nightmares from shoe stores
And hush
going with my
puppies?
parents every time Easter was about to come. Oh, my goodness. So companies have to grow into the shoes of these earnings. And I think that's going to be important for us to see once we get through this phase. And Danny, there is a lot of pent-up demand. People don't care. They want to get out there. They want to get their stuff done. CDC is a bad word. Nobody cares. People are getting vaccinated. They're like, I don't understand what's going on. They're eating in restaurants. They're getting out there. I think it lasts through the summer, possibly the fall. Let's see what happens. But the bond market's not buying that it's long-term, and there's some new paradigm that we're getting into. Hey, when we get back, we want to talk a little bit about IRS. This to fix the inherited IRA guidance that, frankly, confused us and I'm going to try to clarify that for you when we return here on The Real Investment Show.
Alegría Macarena, pues cuerpo da la alegría cuando pueda. Dale a la cuerpo alegría Macarena. Hey Macarena, alright. Dale a la cuerpo alegría Macarena, pues cuerpo da la alegría cuando pueda. Dale a la cuerpo alegría Macarena. Hey Macarena. Now don't you worry about my boyfriend.
You're listening to The Real Investment Show.
Didn't get enough last Lunch and Learn? We're serving up a second helping at our next free virtual Lunch and Learn with MEDICARE on the menu. Thursday, May 6th at noon. We'll sink our teeth into the alphabet soup of MEDICARE, parts A, B, and D. Understanding sign-up periods, benefits, and how to avoid costly permanent late enrollment penalties. It's a second helping edition of our Lunch and Learn on MEDICARE, Thursday, May 6th. Register now at realinvestmentadvice.com. No masks required.
The Real Investment Show.
here's a dose of good news here today. There was a study from the Employee Benefit Research Institute. They do a long-running study on worker confidence for retirement. And about 3/4 of U.S. workers and retirees believe they will have enough money for retirement. So among workers, 72% are very confident in their ability to retire comfortably, up from 63% last March. So the level is one of the highest it's been since 1993. I will tell you what's interesting about this study, Danny. The confidence and the dependency, no matter where these workers fall on their incomes, for Medicare and Social Security to be there for them. So it just shows the importance of planning properly for these social safety nets. Even people who have done a great job managing debt, who have done an incredible job saving, find that when we run their plans for when Social Security is included, it really takes them over the edge. If they had, say, let's just say if they had a 80 to 85% probability of success, this brings them all the way to close to 100% of success in retirement. And these are really good savers because it's a guaranteed income. So retirees, workers need and want and believe Social Security and Medicare will be there. And that is why it cannot go away. It can't. So we did a Social Security lunch and learn, and that was very successful. We are going to do a second helping. We're going to do a Medicare lunch and learn, and that's going to be on Thursday the 6th at 12 o'clock. This is a live, virtual, free Zoom meeting. So this is different than our candid coffee, right? Because Danny and I are actually going through some of the formalities of the alphabet soup of Medicare. A, B, D, Medicare Advantage. Just to give you a surface level kind of overview on the process. We do these in the office. We're gonna start these up in the office again, but our space is limited too, so we're gonna do both. But I'm excited about this Medicare one. I think it's important for people to get a handle. If you are 3 months from your 65th birthday, or close to your 65th birthday, or even closer to that, you really need to attend. You'll get the real good alphabet soup.
Well, if you're close to retiring and you're over 65, you have a special enrollment period.
Yes.
If
you have time,
there's job changes, or you've been on COBRA. I mean, many different things that you need to think about, right?
That's right.
So we're going to discuss all of that, what that means to you, and make sure that you don't incur permanent penalties. Because if you don't sign up correctly, newsflash, it can be really detrimental from a premium perspective, because those premiums could be much higher than you expect because they can penalize you for it.
Yeah, I will tell you, the IRS is direct. I mean, let's put it this way. Medicare, Social Security, they're not going to, if you mess up and you wait and you fall off the proper enrollment period and you have late enrollment penalties on your premium, that's 10%.
There's no redos here either.
There's no, I'm going to tell you, there's no pleading with the IRS. I forgot, whatever it is. I made a mistake. These are permanent. And roughly about the average premium for Medicare Part B is up about 30%. Because again, because of people that have missed.
Well, the average penalty.
The average penalty is 30% because of people who haven't made a good decision. In all fairness, it is not communicated very well. There have been acts out there to make sure people getting close to Medicare understood the rules, make it clearer. But again, poor job of doing that. So Danny and I try to make up for that with this stuff. So now, the stretch IRA. I have my daughter. She's a beneficiary on my IRA. If I pass away, she used to be able to take that money out over her life expectancy, right? So I'm getting, in essence, maybe the tax deferral over a longer period for her. It would be a small amount, her being 22 years old. Now the IRS came out last December before last, and said, hey, no, we are going to change this up, where your non-spouse beneficiary has to take this money out over 10 years. Again, and I'm talking about someone who's the age of majority. Okay, if you have a minor who's a beneficiary, they are actually able to take it over their life expectancy up until the age of majority and then follow the 10-year rule. But this caused a lot of confusion because in publication 590, they were talking about that you would have to almost make this a required minimum distribution over 10 years. In other words, there's a table, you take the money out. When we were all thinking, and it was the information we were given, is, hey, I could take it out in year 1. I can skip year 2, take it out in year 3. I could take it all out in year 10. In other words, I've got some flexibility. So there was a lot of confusion about, oh my gosh, we got it wrong because the IRS now has something in there. Well, now I guess they are, the recent IRS publication was obviously incorrect. And now they're going to be looking at that. They're going to revise the guidance to reflect that such distributions that are taken just are following a 10-year rule, which is what it originally was. So we're going a little bit back and forth. So that recent IRS publication really caused a lot of confusion, thinking, oh my gosh, we need a table. They have to take it every year. And I'm not saying maybe you don't have to take it every year, but it would be nice that you can mold it over a 10-year period, because I think some people are going to be in for a big surprise, Danny, if non-spouses inherit, because they can say, well, I haven't taken a distribution, no one's coming after me, and then in year 10, bam, right, I've got to take this all out. So it doesn't mean that you have to be lax with it. In some ways, the R&D would have been giving you a bit of discipline to know
that's correct.
You have to take it out. So it's going to be up to you and your advisor, if you're a non-spouse beneficiary, to be very cognizant of this 10-year rule, taking money from an inherited IRA.
I think that these guys have one job, literally one job. And they put out a formal publication stating that things are going to change. Then they're going to come back and say, well, never mind, we misinterpreted that. How do you misinterpret that if you're the guy who's setting the rules? But I do agree. I think this is going to cause or could cause more confusion, whereas the discipline behind having to do those distributions could not be a terrible thing.
I don't know. The IRS seems like they've got a lot of things that they need to clear up. But most important is we get the information, we supply it to you, and then we have to change it because that's changed. And some of us were in a bit of a panic going, oh my gosh, now it's going to be new tables and all that.
Well, that's the thing, right? They never typically make it easier. This will actually make it easier in the sense that you're not going to have to calculate each and every year, but you are going to have to remember that you have that 10-year time frame.
To your point, yeah. Usually when people ask me, hey, this happened, and what do you think the IRS would do? And I said, ask yourself this question. Is it in your favor or their favor? And then you pretty much have your answer. You don't have the specifics of the answer, but the odds of it working out for you are not going to be very good. I just think you need to go with those kinds of rules overall.
I mean, I think that's with anything in life, especially when it comes to big government.
Oh, man. Well, speaking of big government, we are going to be in a storm of possible new taxes. We are looking at, again, we don't know what actually is going to go through here, Danny, but we have been talking about for at least 3 years. Taxes are going higher based on demographics and the dependency on social safety nets. And we are going to see changes coming. And we have to prepare for those changes. And one of them is on capital gains taxes, all right, where it's going, we're going to look at more than double the current capital gains rates. To help people understand, generally speaking, your long-term capital gain taxation rate is lower than ordinary income, right? So, and there are a lot of reasons for that, right? Try to spur small business, whatever it might be, to create innovation. But now we're going to be looking at not only a proposed increase in the top marginal rates for those earning more than $400,000 or households earning more than $400,000, so that's $200,000 each, but also capital gains tax increases for investors earning more than $1 million a year. So if I go from 37% to 39.6%, then I'm going to have I have Medicare. I also have a Medicare tax I'm going to be up to 43.4%. If I am in a state that taxes me locally, as well as state tax, right, I'm going to be looking at over 50%.
Well, think about this for business owners, for people who have built wealth over time and worked hard at
Small
different
businesses.
things. Yeah.
Yeah.
Well, their current rate at this level would be 23.8 with the Obamacare tax on top of it, right? Because long-term capital gain
Right.
rates, they top off at
Right, but you have the
20%.
Medicare surtax.
Correct. But
Right.
with that Medicare surtax, you're looking at 23.8. So you are almost doubling the amount of tax here.
And if you don't think that's going to affect behavior, you're absolutely wrong.
Oh, this is not a good thing.
No. I mean, I understand even some of the marginal rate increases. I even understand the payroll tax increases to sort of, bolster Social Security because people depend on it so much. This one, I don't know, not really. I'm not really getting it. And I think the bond market's also looking at this as well. So where are people going to move their money? Well, one is municipal bonds, tax-free bonds. That's going to be a big thing, right? People are going to be looking at, and we're going to talk about this on the other side of the break, but you have to think about if you're one of those people where taxes are going to increase, especially capital gains, how is that going to change your behaviors or how you invest? We'll talk about it a bit on the other side of the break on The Real Investment Show.
I am a man of constant sorrow. I've seen trouble all my days. I bid farewell to old Kentucky, the place where I was born and raised. The place where I was born and raised.
Listen anyplace, anytime at realinvestmentadvice.com.
Didn't get enough last Lunch and Learn? We're serving up a second helping at our next free virtual Lunch and Learn with Medicare on the menu. Thursday, May 6th at noon, we'll sink our teeth into the alphabet soup of Medicare, parts A, B, and D. Understanding sign-up periods, benefits, and how to avoid costly permanent late enrollment penalties. It's a second helping edition of our Lunch and Learn on Medicare, Thursday, May 6th. Register now at realinvestmentadvice.com. No masks required.
You're listening to The Real Investment Show.
So we've just discovered that the metal shoe thing weapon that used to be used in shoe stores that my grandmother would chase me around with was called the Brannick device. And actually, thanks to Pat,
Yeah.
he told us. But I'll tell you, that's even scarier name because it sounds like I am coming after you with the Brannick device. That sounds like a bad movie, sci-fi movie from the 70s where robots eat people.
How would you like to have the Brannick procedure?
Yes, that's what I
you?
mean.
Yeah.
No. So the name lives up to its fright. Ooh, goodness.
It acts like it's some torture chamber. We're measuring feet here. Come on, Rich.
I had a vivid imagination as a child.
Clearly.
And when your grandmother's chasing you with it, it's a weapon. All right?
True.
Yeah.
Why?
Sure.
Because, Grandma, why do I need to wear shoes that are 2 times the size of... Shut up! Pull right out of Sal's hand to hit me with it. Yeah, and I'm very well adjusted. So I want to help you understand is we got a great question about housing. And, is it a bubble or what's going on? Let me tell you, this is the weirdest period of time I have ever been in this business over 30 years. Where, 2008, we know what it was, right? We know what kind of crisis we had. We had a banking crisis, and then we had a tech crisis in the tech bubble. But if I own consumer staple stocks, I was okay. It's almost like when you got your garden hose on. But imagine that garden hose, that end of it, and the water. Imagine if that water was coming out. It was 3 times the pressure. That's the kind of liquidity we have. The water is going everywhere from all the liquidity, right? So everything is distorted in price. I have a client who's a realtor, and she said to me yesterday, she goes, Rich, you wouldn't believe what's going on. I mean, if you waive in appraisals, people are waiving, because to buy homes, they're just making, she goes, I can't advise my clients to do this. But people are making crazy decisions to buy homes. But it's not just housing, right? It's stock market. And it's crypto. And it's tokens. Do you know? Okay, this is what killed me. There's something called virtual land. In other words, you create this, like my kid has something called The Sims as a kid on the computer when she was a child. And you can make all these little towns and, municipalities and homes. Well, now they do it through the blockchain. And they create these kingdoms and so forth, and they are selling them. Like you would an acre of land, like real land. They had a guy that bought like some kingdom with a castle for like $450,000. I mean, in dollars, not Bitcoin currency. I don't understand it at all. In other words, I've got cash. Let's create something. Let's build supply and demand. We'll play amongst each other with this until it breaks. And I've never really seen anything like this. And I didn't say that in 2008. And I didn't say, even though I was like, my gosh, this is strange for the housing market. I've never said everything is getting distorted by this monetary and now fiscal policy. And I don't really know. Lance and I were talking about it yesterday morning. I don't know how it unwinds from here. But if I'm going to buy a home today, I'm probably going to wait. I'm looking to move. I'm like, I'm not going anywhere right now. There is a house in my neighborhood. And I'm going to tell you something. I live in a very modest neighborhood. Okay. The houses, maybe the top end are like 320, 350, whatever, right? This guy's trying to sell his house for $590,000 in my subdivision. And my subdivision is pretty old, right? Because people are saying, I can try, like he renovates this house. And I remember when the house wasn't renovated. There's no way in heck this guy is going to get $590,000 for this house. Well, but he's going to try.
The neighbors need to have a talk with him. Because if he succeeds, what's going to happen is the county is going to come along and say, aha, this house
he'll set off a whole wave of...
Yeah. And so everybody else's taxes are going to go up because of the way that they assess real estate taxes in Texas.
Well,
it's he
happening
is
everywhere.
Double what it should be. I mean, again...
That's ridiculous.
We're seeing crazy things. And the toughest part about anything you do with money, stocks or anything else, you have to keep a cool head. It's not easy, but you have to. It's just crazy.
Well, there's more to this, though, too. I mean, if you start thinking about this, I was visiting with a real estate agent who's a client this week, and we were talking about just this. And he was having phone calls saying, hey, you do realize you're going to have to go over the asking price.
Oh yeah, you have to offer have to offer more, right?
Like you said, there's people who are saying, hey, we're going to waive the appraisal. We're going to have to come up with additional funds if it doesn't appraise. You're setting limits,
significant down payment.
Yeah. I mean, he was just showing me some stuff, and I'm in no place to buy. I don't want to go buy a house. I have a house, but we were talking about some of these things in like Galveston area, beach houses. He said he saw one that was listed bought 2 years ago for $850, and it's on the market for $1.2. He said he asked the guys, like, what are you thinking here? He goes, well, I'm thinking what everybody else is thinking. I'm trying to get all I can out of it. And that's, I think, we're seeing. But I think we're able to do so for a couple of reasons, right? There's such a distortion in the supply chain. I mean, look at the price of lumber. So all these new houses are still going up, ultra low interest rates, and you're having to pay, lumber's up like 200 and something percent. And so you're having to pay that much more just to build your house, meaning that house is going to now be more expensive. So everybody else is saying, well, hey, if these houses are going for this, our own homes now that we own they've been inflated as well.
Yes.
So how does that come out of the supply chain will even out over time, but how does that come back out of home prices? That's just some of the thought process I've thought.
I don't know, because like Lance, I told Lance what my house was worth now. It's like $260,000, and I'm like, this is crazy for my house.
Yeah.
I mean, and where am I going to go? Because anything I look at is overinflated anyway. So I'm just going to stay put and wait for all of this to see what
the key is.
As things moderate, supply chains moderate.
I would say to anyone buying a home right now, there's so much speculation in the market. If you're going to buy it, this is going to be your home. You're going to have to expect to live here for an extended period of time.
You better be planning
to make
over
your money
7
back.
years, right?
Yeah.
As opposed to normal stay. And you better be planning to put quite a bit of money down because you might be underwater.
Could be.
You never know because nobody's getting appraisals, right? Not nobody. I'm saying, but there's people that are buying homes without appraisals, and if you have more than 0.5% down, the bank's going to give you the loan because you're taking on a lot of risk to buy this house. So if you're just a normal home buyer and you want to put 5-10% down, you got to compete against all these people that have more cash and appraisal and all that stuff that you will need. The bank will require you to get. Somebody comes in with 35% down payment, pays full price, says we don't need an appraisal for that because I was putting down 35
or cash.
Yeah, or cash. So it's very challenging. So I've always known during challenging times to stay put and wait for things to clear. It's just like what we do with the market. I mean, you're not going to go ahead and sell your home just because you can get a great price for it, unless you're going to look, and Lance would do this, look to rent until prices come back. But that's very disruptive to most people. They're not going to do that. At least we are, when we invest in the market and we understand the distortion, we're at the party. We're all talking. We've got the punch bowl, and Brent's talking about, his incredible fancy date at Lupi Tortilla, and we're all talking hobnobbing, but we're looking for the exit. We know where the exits are. We know the path to it, but we're still going to be at the party. But if you're going to buy a home, to your point, Danny, you better be planning not only maybe to put more down and be willing to maybe forego inspections, which I think is crazy, by the way. That's crazy, right?
I don't think anybody's going foregoing inspections. I think it's the appraisal.
No, but inspections too. My realtor,
really?
Yes, she says, you know what? Some home, this guy's willing to buy it even without an inspection. So,
man, that's where you get bit.
I mean, you're gonna get right. You're gonna get hurt. So if you're just caught in the frenzy of I gotta move, and house prices are going up and all that, you might just want to sit it out for a bit.
Well, it's just like buying a stock because it's gone up.
Yeah,
and not looking at the numbers.
But you know what's the best part? Because I never ever look at real estate. With a stock, at least I can sell it. I can get out.
True.
If I make a bad mistake with real estate and I can't find another buyer, I could sit on that thing for how long?
You could.
For a very, very long time. And then I still have to pay my mortgage and all this other stuff.
But it's similar with the stock. You can just get out of it quicker. It's just going to be at what price can you actually get out?
Right, but at least I can like to point get out. So liquidity, illiquidity. But to Danny's point, which is very good, you better be willing to stick around at least a decade if you're buying a house today. That would be, I think, really sage advice. Also, if part of this Biden tax bill would be to remove step-up in basis.
Yeah.
So
that's a game changer.
That's a game changer, right? Because they're saying, hey, that only affects the very wealthy. No, it doesn't.
Well,
no, it doesn't.
Think about all the life insurance policies that are being bought right now to cover estate planning in the future of what that may or may not look like. What's going to happen when this is another caveat? You have to start thinking about the step up in cost basis and the additional taxation from that, not just from the estate tax. So you may not have enough wealth for the estate tax, but you may have a lot of wealth in a home, in a land, a piece of property.
Yeah,
and
exactly.
The one thing I'd advise anybody is make sure when you do this, do it within a financial plan so you know and understand exactly what you may or may not need. This isn't something we just throw something out there, but we'll talk more about that when we get right back. You're listening to The Real Investment Show. We'll be right back after this quick break.
listening to The Real Investment Show.
Didn't get enough last lunch and learn? We're serving up a second helping at our next free virtual lunch and learn with Medicare on the menu. Thursday, May 6th at noon. We'll sink our teeth into the alphabet soup of Medicare, parts A, B, and D. Understanding sign-up periods, benefits, and how to avoid costly permanent late enrollment penalties. It's a second helping edition of our lunch and learn on Medicare, Thursday, May 6th. Register now at realinvestmentadvice.com. No masks required.
The Real Investment Show.
And welcome back. Last segment. So we were talking about the possible or the thought of higher capital gains tax. How would that change the behavior of a business person, or how would I invest, right? So first of all, it will make, I think, Roth IRAs, Roth 401ks much more popular because my distributions will be tax-free, right? Because if my capital gains are going to be taxed as close to my ordinary income, I lose some of the benefits of just having a regular brokerage account unless I'm owning, say, for example, municipal bonds, right? I'm very tax efficient, but still, it's still not going to be the same as tax-free on distribution. So I expect to see really big, and all of a sudden it just seems that as we talk about Roth's gotten more popular because you forsake tax benefits today for tax benefits or benefits tomorrow. And while you have the money to pay taxes while you're working and a human capital machine compared to when you're retired and you don't really have the money to pay the taxes and you're not earning, or unless you think, one, you're going to fall into the lowest tax bracket. I have proven that 8 out of 10 times it's a myth. Plans show it. This is old advice given by advisors through the greatest bull market in history, where tax deferral was this huge snowball and people lived simpler and costs weren't as high or whatever it might be, but you're not going to fall to the lowest tax bracket. And if you are, you're living very small, and that's okay. I could do it. Most people cannot do it, and I don't blame them, okay? So you're not going to fall into the lowest tax bracket. Or you say you are, or you think also taxes are going to go lower. You think taxes are going to go down in the future. What are the odds of that, Danny?
Well, I think we're seeing what's happening right now. Now, they may come down from where they are right now. And look, we have to take all this with a grain of salt. Mm-hmm. This will likely be a little different than what they're throwing out.
Oh, absolutely.
They're going to throw the highest and worst thing out there, and then they're going to
and work backwards.
Taper it down from there. Correct.
But even if we do nothing, the current tax rates, the larger marginal rates, 22, 24%.
They will sunset.
They're going to sunset at the end of 2025. And an astute administration, regardless of the side of the aisle, will say, hey, we're just going to let those sunset. That's not our decision. That was a prior administration's decision. Mm-hmm. We're just going back to the way taxes were. See, they're going to benchmark you or anchor you to those tax rates because we knew they were coming back anyway. But that is going to be a tax increase for you. And I think whatever administration's in, Danny, they're going to have to make the tough decision to let those sunset based on all the stimulus and all the debt we've taken on. I think they're going to, even if, say, it's a Republican administration and they don't want them to sunset, I think they're going to have to.
I don't think
someone's
we're going to
have to make a tough
far,
decision.
but yeah.
No, I know. I'm just saying, if like you said, if nothing happens and we get to that point. Because remember, that's not just for people making $400,000 or more, right? Or $1 million or more, or whatever, they grab these numbers out of space. It's going to affect everybody when these marginal tax rates sunset.
Oh, yeah.
And if the standard deduction goes back to what it was.
Half of what it is today. That's also a big impact. And that's going to be interesting to see how it transpires. Don't jump the gun. Don't be making just impromptu or just decisions off the top of your head.
You run a plan, you try to figure out what the landscape's going to look like and make intelligent decisions. I will tell you, it is tough not to get emotional about. And I notice people, they're extreme about everything today. I mean, like somewhere you got to think in the middle and keep a cool head with everything that you do. There's just been an emotional battering to the society since we've locked down. You know, they got all these studies about how loneliness has become part of, the society, what's happened during the people losing touch with other people, not being able to visit, losing loved ones. I mean, the long-term impact of a lot of these things. So emotionally, we're all on our tippy toes here. We're trying to, and at the same time, make intelligent decisions with our money. Not easy to do.
No, not when we see asset prices doing what they're doing. We have conversations every day with people who, questions about cryptocurrency, about real estate, like you mentioned.
You want to buy a
stock
kingdom?
prices.
You can buy a virtual kingdom.
A virtual kingdom. Now, this is new to me. I have not heard of this.
Yeah, look up virtual land gains.
Virtual land gains.
Virtual land for sale. Take a look. And whatever sanity Danny's got left, it'll be over by the end of the show.
I'm just curious, so what's the purpose of buying this?
I don't know. That's my point. I have no idea.
Like,
what am I going to do with it?
Well, everybody's going to live in their altered world.
That's what it maybe it is.
Virtual world.
This person really developed this kingdom. It's got roads. I mean, look. In other words, it's got better infrastructure than we do out here in the virtual world. I mean, what am I going to do? Immerse myself into what is this, Tron? What am I don't understand. And I don't understand paying $1 for it. Bad enough, $400,000, $1 million for this stuff.
Hey, I've got a mansion and a pool.
It's virtual.
In Decentraland.
Is that what county is that in, Danny? Insano?
Yeah, something like that.
Yeah, but that sounds really... Hey, you single guys, I got a really good pickup line for you. Danny just used it. Hey, I got a house and a pool. Where is it again?
My pool.
Where is it again?
Decentraland.
It's in Decentraland. It's my
Never heard of it.
Yeah.
Oh, it's beautiful.
It's...
On February 9th, the world woke to the news that a piece of virtual land, 9 adjacent blocks on blockchain marketplace and gaming platform Axie Infinity has just sold for a record-breaking sum
Hold on.
of roughly $1.5 million.
I am going to pull whatever hair I had in my head right now. Brent, $1.5 million.
$1.5 million?
For Decentraland.
But they paid in Ether. Of course.
You know what's going to shut all that down?
Ether. Real Ether.
When the IRS comes and says...
Oh, let me tell you something. There's like an $80 billion addition to the IRS into this bill. Because the IRS is still using like the Zune or the first Apple or whatever they're using.
Oh, for sure. It's like everything's in code.
In 5 years, 5 to 7 years, the money that they're leaving on the table with all this crypto, they're coming. They are going to come for you, or there's going to be, and Yellen has already leaked it, talked about it, Powell, a Fed crypto, some form of crypto that is actually can be used. And or this gets regulated. All I'm telling you is if you have anything crypto, you better be taking profits in real dollars that you're going to spend to buy like food, pay your... I was on the Reddit board the other day, and it's 23-year-olds, 25-year-olds. I'm retired. I'm retired. I'm retired. I got all these tokens. I'm retired. I've got $10 million. And I'm like, well, how are you getting an income to pay your rent from that?
$10 million in what?
In like, crypto.
You're such a buzzkill, Rich.
I am. I should not be on these boards.
Hey, I could figure that out.
But all these like millionaires with their fungible tokens and their NFT, all this stuff, and I'm like, well, have you convert, to actually when you have to pay your rent, they're not taking Dogecoin. Your landlord's not taking that. Dogecoin.
Doge.
Doge.
Get it right.
I still doggy to me.
I know. I get corrected every time. It's great.
We're coming up with Kitty coin.
I
Brent,
saw that.
you want that?
Yeah,
Yeah.
explain that.
That's just, kitty.
Yeah.
Kitty coin.
Instead of doggy.
Yeah. Yeah, and you get a free tender vittles or whatever with it.
Karina or somebody should come out with this, you'd think.
Oh, if Elon Musk says, I'm going to release Kitty coin to complement Dogecoin by tomorrow.
For all you cat lovers out there.
Yeah, for all you cat lovers.
That's a whole new meaning for virtual scratch.
What I'm saying is, with all the fiscal and monetary stimulus out there, the liquidity is busting through the hose, and it's going everywhere. It is going everywhere. Did you see the NFL dude that said he wants to get paid his salary in Bitcoin?
No.
I don't remember his name. Obviously big guy.
Yeah.
Very articulate. But the NFL goes, well, listen, I think it was the NFL. We're going to pay you in dollars.
You can convert it to whatever you want.
But he goes, then you can, and he's converting all his salary to Bitcoin. I mean, very articulate, had a very good rationale for why he was doing it. But I'm like, my goodness.
Look, I'm not going to knock it. People do what they want to do. I'm not going to knock it,
and I don't think it's going away. It's just.
But I don't want my money in cash in something that's so speculative where it could be up substantially or down substantially. I want to invest the funds for something like that, right? So if it's an investment for a portion of what you have, fine.
And wouldn't I be liquidating?
But not for everything.
If I had 10,000 in Bitcoin and I made it, and it's now whatever it is, 65,000. Wouldn't I be like selling and taking profits along the way and converting it to real dollars as opposed to getting greedy with it?
But Rich, and you don't know how high it will go.
Well, I'm going to buy the other property, and what's that land again?
Oh, well, there's Decentraland, Axie. There's a bunch.
Decentraland.
The Sandbox. It is now becoming a legitimate asset class.
The Sandbox.
Oh, yeah.
Okay. So Kitty coin could be used in the Sandbox.
There you go.
All right. Sounds like turds to me. Listen, you all have a great weekend. See you next week here on The Real Investment Show. Be safe.
Must be funny in a rich man's world. Money, always Sunday in a rich man's world. All the things I could do.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.